Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 16th, 2016. Just want to do a video update. There's really not anything new to cover that I haven't posted lately in static form or videos. I'm doing this video. The market's a little slow today. It's actually up healthy, and that's one reason why I wanted to do it. The Qs are up over 1%. As you can see here, it's a little after noon on noon Eastern time today, and we're up about a little over 1% right now. And the Qs are the index. I'm watching them all, of course, but that's been the leading index, so I have a lot of focus on the Qs. So I figured what better time to do the video, now when the market's up. My point being here, my views haven't changed. One day up today, down tomorrow. That's just been the trend lately. In fact, let's just take a quick look. I made mention in the trading room today that we've had a couple over the last couple months. This was a trend, and at the end of that trend, there was a bearish rising wedge pattern. We're looking at a 60-minute chart. We had these two periods, as you can see here, of consolidation, sideways consolidation. During this period, we broke down from the wedge, and then up here during the second period, we back tested, and prices held up longer than they usually do. From my experience, once you break down from a bearish rising wedge pattern, assuming it's going to play out, which most do if they're confirmed with divergences, then usually either see prices begin to move down from there, or it depends on market conditions, but it's sometimes you almost have equal odds on seeing a back test, which we did here, but then prices usually move down. This has been sort of a slow rollover in the market here. We had the back test, and then we stayed in that sideways trading range for a good part of April. And then we had a nice trend. We had a downtrend. It was defined by this channel. We broke out of that channel. We had bullish divergences on the lows on the 60-minute chart and 15-minute chart, which I highlighted. And since then, we've traded around in a sideways range, and pretty much throughout the month of May, as you can see here. So it's been frustrating. Sure, there was a little punch above there. That was at 106.80 level. Like I said, we briefly took out. Now we're testing it again. So we're really bounded by those levels I've been watching, since we were way up here. I pointed out the 106.80 level and this 104.90 level. You also have a fib support there. And that's it until we break out of there definitively to the upside or the downside, which I think will happen soon. This is pretty just kind of eyeballing the charts and going from experience. I think we're likely to go one way or the other soon. Trend indicators, because of the sideways trading range, this is when trend indicators don't work so well. We've had a couple whipsaw signals, bullish, bearish. So I'm trying not to extrapolate too much. That MACD line's just dancing on the zero level, which often defines bull and bear trends. So again, not any new developments. I just want to point this out and do this video because I imagine there's a lot of frustration, whether you're bullish position long looking for new highs or bearish looking for a breakdown, which I still remain at this time. And just on that, to digress for just a minute here, I replied to a question. It was posted in the trading room. It actually came through because I get email alerts. I'm signed up. If somebody comments on a post I make or anything, I get an email. So I thought it was an individual email to me, and I'll share that reply. It was Lee in the trading room. Lee one asked, he's looking for new highs, and I told him I fully respect that, and that's quite possible. And I think that's what makes a trading room a great thing. My opinion, my reply to him is I've been wrong before, and I will most certainly be wrong again many times over. My analysis isn't always correct. Nobody's is. And so new highs are a possibility. But what I try to do, if I don't have a strong opinion on the market, I'm quick to tell you guys that the near-term outlook is opaque or unclear to me. But if I can make a pretty solid case that the market will either be heading lower or higher in the near future, then I make that case, and I try to do it without painting an ambiguous case. In other words, you give me at any point in time, I can make a bullish or a bearish case on the market, just about any point in time. However, that conflicting, confusing analysis, I don't think does anybody good. So just keep that in mind. If I believe the evidence is clearly skewed to the downside or upside, I'll make that case. And although I might see things that I could make the opposite case, I'm not going to do that. I try to keep the analysis clear. You can either agree with it, disagree with it. If you're unsure, stay out of the market. But I just wanted to make that point. And, if and when this bearish case that I'm looking at begins to diminish, then I will, I'll state my thoughts as that happens. But as of now, it hasn't happened, and it is frustrating to see these sideways trading ranges and this slow rollover. Maybe this was a correction on the move to new highs, like Lee and I imagine some others expect, or maybe this is just a consolidation before the next wave down. So let's just tear into the charts real quick, and I just wanted to I'll focus only on the Qs today, and we'll take a look at some of the top components of the Qs as to why I remain near-term, intermediate-term bearish right now. This is a daily chart. I've shared this many times, so I won't go into too much detail. But if you look at, what's happened, we had that large, very steep rising wedge off the lows in February, a breakdown, a back test, which we just saw on the 60-minute chart as well. And if you look here, this to me looks like an initial leg down and just a consolidation, sort of flagging action, if you will. Let's look at a clean board just to get all the lines out of here. So you see the impulsive move down, impulsive meaning you have a lot of red sticks, a near vertical drop, and a punch up. And so far on low volume, if you look down below, that's typical of a flag. I have my volume bars muted down. I'll turn it up a little for you here so you can see the volume bars on the bottom. So you can see that the move up so far is sort of flaggish in nature. May or may not be a bear flag. That may be the breakdown there. Either way, the essence of a bear flag or bearish pennant, those are continuation patterns, and just shows that at any point after an impulsive move down, you tend to have that consolidation, tends to be on lower volume, and then a breakdown. Now we're up today, but we're really still within that trading range. And as I pointed out in some of the recent videos or static posts that I've done, we have this trio of what I call key moving averages. Everybody uses different moving averages. Some people use simple moving averages. They all, my take on that is whatever averages do the best job, especially in recent months, of defining a trend. So you can see here, for example, that 20-day EMA, that purple line, has done a really good job. A lot of traders watch the 50 and 200 day EMAs. In fact, that's one of my trend indicators on a daily time frame, is whether the 50 EMA is above or below the 200. So we recently had, as I pointed out, a bearish cross there, also known as a death cross, when the faster moving average moves over a slower moving average. We had that occur recently. I have those lines turned down, but if you can make it out in the video, you'll see we still have the trio of the 50, 20, and 200 day moving average, all key EMAs where prices are still below. We broke down, they all came together, they're converging here, relatively close proximity. Prices, just as the 20-day moving average did a good job of containing the uptrend here, so far it's contained the downtrend. We had these two candlesticks challenge it. I think you can make that out in the video. If not, you might need to turn the brightness up on your screen, but I can do this real quick to show you that line. So there you have it. And the other two, I have those muted down. I like to keep my charts relatively clean. Too many lines and colors just kind of takes away from price history, which is most important. So that's that. So the fact that we're below all those EMAs, which are likely to act as resistance, this just appears to me like a thrust up. And today's action hasn't done anything in the charts. It is, I have pointed out, and I want to harp on it, there's not ever one line in the sand or one resistance level that's the be-all end-all in trading. But this is an important level, I think, that 106.80. It's been a battleground in the past, acting as support. And we had that little fake out move, and we're back testing it again today. And the next level, if we get above there, is about 108.46, call it 108.50. It's a possibility. It would be bullish note undoubtedly if we broke above there, especially above the recent reaction highs. But we're right there. We're at resistance right now, so let's not try to read too much into it. And in fact, whether you're bullish or bearish, well, if you're bullish, you wait for a breakout above resistance to go long. So maybe the 106.80 level, give it a 60-minute close to be safe, and then you want to maybe watch for these reaction highs to get taken out. A move, and especially a 60-minute close above those previous reaction highs from last week. That would be the next bearish technical event. Then you have this 108.50 level to contend with. Now, if you're bullish, you want to go long on breaks of those. You wouldn't go long just in front of a resistance level. That's contrary to trading, in my opinion. You wait for a breakout. Likewise, if you're bearish, you can short here. You can. Somebody asked today, and I posted my response. How do you position for the big moves if there is a big move? If in the coming weeks to months we are headed lower in the broad markets, well, these are the times if you weren't shorting up here when the wedge broke and we back tested, or when we broke that 108.50-ish level, then you want to short on bounces back to resistance, and you can place your stops above. The same levels I just mentioned for a long side trader to go long, those are resistance levels. So if one were to short here at 106.80, you could set a very tight stop a little bit above those reaction highs from last week. Your next stop would be a little bit above. Remember, I don't set, if I'm short, I set my stops just above the actual resistance level. Same way I cover just above the actual support level. And I do that because if they're going to run your stops, they meaning the big boys on Wall Street, the ones with the money that can move the markets to run stops. Undoubtedly, there's a cluster of stops probably right above this reaction high. The next cluster of stop loss orders or alongside buy orders would probably be right above that 108.50 level. And that's how it works. So if you're Goldman Sachs or whatever you name, whoever has enough money to, especially on low volume days, which we see in the summer, so the doldrums we call it, trading volumes drop off during the summer months, and it's easier for those with a lot of cash to move the market, and they only have to move it sometimes just a few, some basis points, maybe a 0.5%, whatever it takes, and they can pop those stops, run them, and then position short themselves and for the next leg down. So that's why I always set my, if 108.46 is the actual resistance level I'm targeting, I might have a stop at 108.55, or I might wait for a 60-minute close above the 108.50 level. All right, enough on that. So that's the charts, and like I said, here's what we're doing. It's frustrating, but sooner or later we'll break down from that range. Now let's just wrap this video up. Just a quick overview of the top holdings in the Qs, QQQ. As I mentioned, that's been my primary focus lately. And first, we're looking at Google here. This is Class A, Alphabet, I should call it. I'll probably call it Google indefinitely. Left shoulder, head, right shoulder. I mentioned this before. It's busy on this chart because there's a lot of lines. Let's just go to a clean board here, and you'll see what I'm talking about. So this would be a left shoulder. I won't take the time to write in the letters. Just put note, note, note. There's your head, and there's your right shoulder. Not perfect symmetry, but good enough symmetry, in my opinion, to validate that pattern. I had a couple draws on the neckline, couple alternatives. You could draw one down about right there. Yes, there's a gap here, but that doesn't matter. Prices pass through there. If you're looking at a line chart would connect. You wouldn't see a gap. Candlestick charts show gaps. But I'm partial to this neckline. And when trading any chart pattern, in this case a head and shoulders pattern, if I have two support levels that will trigger a breakdown of that pattern, such as I have here. I have a horizontal line about 703.72 and a downward sloping neckline, which I actually prefer. I see it catching more reactions on the downside and from above. I err to the side of caution. This is where, if I were to short Google, I have enough short exposure on the Qs right now. I'm not saying I will short Google or I won't. We'll see what happens at the time, but I don't plan to. But if I were to, just watching this pattern, I'd wait for a break of this line. Why? Because if more traders are watching this as a level for that pattern, key support level, and you short here, well, you have minimal downside, and then prices could reverse off that level. So you could see on that horizontal line we had a tag, and so often the initial tag of a support level from above produces a reaction. So right now, the symmetry's there, and if you don't see it, I'll just draw it out here. There's your left shoulder, there's your head. I'm not doing a perfect job on the lines. Here's your right shoulder, and it could either be finalized on that neckline or, like I said, come down here. And if we hit that, we might get a reaction. Very often you get a reaction once the right shoulder's finalized. And then finally, your trigger would be a break below the neckline. And you can see on this chart, you can see some nice, let me clear these lines out, some nice support on Google right here. You have a bunch of gaps down here, reactions, some reaction highs. So it would almost be a zone really from about right there all the way down to about right there, 604. So that's Google, and I just wanted to point out everything's playing out. On the daily chart, I noted the divergence. It's not drawn out here. You had divergence on the RSI, divergence on the MACD with prices making a higher high. And most importantly, as I often say, head and shoulders patterns are probably one of the most recognized patterns in trading. Everybody knows them, familiar with them, but most people don't scrub them for volume patterns, which are very important. Volume patterns on a head and shoulders pattern, what you want to see is an expansion of volume off both the formation of the head and the right shoulder. So from here down, as that head was formed, you did have the expanding volume, just as you did on the move down so far off the right shoulder, an expansion in volume. So, and again, head and shoulder, it's just a potential head and shoulders pattern because we haven't finalized that right shoulder, nor have we broken down and triggered a breakdown below the neckline, or at least the preferred neckline that I have. All right, let's talk on Apple. Apple's, doing a heck of a job trying to regain that level today. It's up, strong 3.4%. So if you want to look at it from the bullish perspective, so far this may prove to be a bull trap or a fake down. I mentioned that as critical support. I had these two lines here. I probably should turn that one. 92.50 was the bottom of that support level. I should probably color that level, that line orange also, match them up. So we broke down and impulsively broke down. You can see the big red candlestick from last week that happened there. And so far we've regained that, but only by a relatively small margin. And the day's not over yet. Something to watch. I mean, Apple's still moving up. Let's see if it can hold that level. And if not, then we move back down. So we are at, as I mentioned, the Qs are at that bouncing back to that pretty important level that I just mentioned. And Apple here trying to take back that 92.50 level. So right now, keep it light because if the market moves up much higher from where we are today and Apple moves up much higher, then we've gained some pretty important resistance levels. And that could change the technical picture. So not in any way that I would be covering my shorts, not just yet. We have a ways to go, but just something to note. If we build on these gains throughout today and throughout the week, then we may start chipping away at the near-term bearish case. But as of yet, it hasn't happened. Microsoft, I don't have a lot of, enough on this chart. There are a lot of lines here. Just disregard everything to the left. This is a horizontal line. You have this gap here, actually two gaps. You see the top of this gap back here on it was about December 23rd, 26th if I hit that, October 26th if I hit that right. Then we had the bottom of that gap right here. See this large gap? So this horizontal line about 52.25 is defined by not one but two gaps, and those are big levels. When you have multiple gaps that define a level, that's solid resistance, and you can see prices are just below it, as are most of these key moving averages. Again, I have them muted down quite a bit here. You can put them up on your chart and see. So Microsoft just looks like it's bouncing back into resistance. And this is actually an objective area to short. It's like I said, maybe we push on through here, but if you want to short when everyone else wants to buy, you want to go long when everyone else wants to sell. So it's not easy to do when the market's up 1%, but if you have an objective entry, that's what you do. So for those, I mentioned in a post today on the front page how to get into position for a longer term trend. Well, obviously, at the highs recently, this was the most objective area on the Qs back up here when we broke down from that wedge to be shorting. But if you're not short or you started to and you want to add, this is where you add. Or your next objective entry is a solid break below that 104.90 level. All right, a couple more holdings. We already looked at Google. That's the other class. There's Facebook. I have a couple other charts. Let me find another board. Okay, here's what I see on Facebook. This whole cluster of prices, we had that big gap up. Prices have traded within this ascending price channel since, excluding, this was a just sort of an overreaction on the day gap. Prices usually have these order imbalances. So this is really where trading normalized, and then we've been moving up. And this is a 60-minute chart I'm looking at here. So we broke down, pretty impulsive breakdown below their channel. Now we have support. These two lines are pretty important support levels. We have this reaction high back here in late late March, and then the other reaction high right there. So that's what Facebook needs to hold if it's going to be bullish. Come back up. Maybe it wants to back test this channel, move lower. I'm bearish. In fact, I have a short position on Facebook individually, and I'm short the Qs, and I have a couple individual components, and this is one of them. And I'll show you a daily chart real quick. It's a daily chart. You can see the divergences drawn here. These lines on the MACD and the RSI down below. Price is making a higher high. This one, I'm sorry, a lot on this chart. It's quite busy. Not, the levels aren't clear enough for me to put this as an official short trade. But then official, unofficial, I share my ideas. You take what you like, pass on what you don't like. Again, I just can't make as strong enough case as I like to for the official trade ideas, but I do think, and I would love to see a nice gap down sometime this week to put in an island cluster top here, island cluster reversal. This is your island of candlesticks. Either way, whether we get a breakdown, a gap down below it, or we break below it, that's some pretty important support right there, around 116.66. And, based on everything I'm looking at down here and everything with the broad markets, I do expect Facebook to break. And Facebook, by the way, is one of the few, just like the next one here, Amazon, one of the few that haven't broken yet in the Nasdaq. See, my theme here is the leading index has finally broken down and has been one of the weakest lately. And even then, it took a while for the big leaders, the top names. That's why I'm going through these stocks. I didn't mention it, but they're all on my watch list, and I'm going down by market cap. If these numbers are right with TC2000, Google must have taken Apple over as the world's largest company by market cap. Looks like a $500 billion company. Again, I'm not sure if that's how accurate these numbers are. Either way, they're both behemoth mega cap companies. So Amazon and Facebook are really two that haven't broken yet, but probably will. And again, if the broad market goes lower, this is one thing you have to realize, no matter how good a chart looks, how good the fundamentals are, if we do have a broad-based sell-off in the equity markets, then the good get dragged down with the ugly. It's forced selling. You have redemptions. You have margin calls. You have forced liquidations because people pull their money out of the market, and the mutual funds that have that money have to meet those redemptions. Just like you or I, the T+3. They've got an order to sell. They've got a little cash on hand. They pay out those redemptions, but if the redemptions keep coming in, most mutual funds tend to run around 3% on cash assets on hand. The rest of that money's invested. So if money's coming out of the market, they've got to sell what they own. And, because these are the world's largest companies, they own a lot. I can guarantee you just about any growth fund out there owns Amazon and Apple, or at least Amazon and Facebook. Those are definitely growth stocks. All right, so that's the chart. Trend line, not crazy about it, but we've eked out to this marginal new high. On face value, new highs are bullish. Let's see if it holds. I don't expect it to hold. We have divergence. I haven't drawn it all out here, but you can see the divergence, negative divergence, about almost equal on the MACD. The RSI is making a series of lower highs with prices making higher highs. 1, 2, 3 against 1, 2, 3, and you see the MACD there. All right, I won't go through every one. There's no need for that. Maybe just a couple more. Here's Comcast. It's not fully drawn out here. It could make a rising wedge pattern here. Oops, grabbed the wrong tool. Got to get my trend line tool there. There we go. Rising wedge, breakdown, near back test, not fully. We had a back test right there actually. So if you really zoom in, so you had your wedge breakdown and back test, and what I would do is put a horizontal line here. So far, like we in the short term, we have a triple top. 1, 2, 3 tags at this level here around 63. We also had a couple tags back there and there. So put another line just above it, really, to capture these previous 3 reaction highs. So there's quite a bit of resistance overhead, and you can draw out divergence here. Not perfect. I'll leave that alone. Let's look at Intel. You don't always have to have the divergence, by the way. It just helps to confirm the trend. Intel's, that's a messy chart. I won't even take too much out of there. These lines are all resistance levels overhead. Um, Cisco, not much. I don't see much there. Amgen, there is something to mention in the biotechs. I should have covered this the other day. I am still short that LABD, and I'm in that one for the long haul, unless the charts change. Now, there is some potential divergence here or bullish developments. I noted this last week. We have this bullish falling wedge pattern here. This is defined by this line here and this downtrend line. There were only a few reactions, 3 reactions, and now we punched up through it. But we also have, I'll change this level. This line should be dragged up here. What that does, you can see this gap right here and this reaction high. So now we're at resistance. This, I didn't post this wedge. It just doesn't look ripe and ready to pop for me. It does have everything I like to see in a wedge, and you can call it confirmation bias if you want. But there's something about this wedge and the overall picture that I don't think it's going to play out. I think this will prove to be a bull trap. But it's there for those of you. I know that a lot of you are interested in the biotech stocks. But at the very least, I would think even if this thing was going to play out, it would need another thrust down inside the wedge because it's just a little too far away from the apex of the wedge. I like to see wedges break out down around this area. This is my sweet spot. Sometimes they break out early, but I doubt that's going to stick. And like I said, there's a lot of resistance. If you look back, that 52.75 level, not only these reaction highs, that gap, you go back here and you can see some reactions there as well. So a lot of work to be done in the biotechs. And, as long as they grind around, my short entry on LABD was right up here near that, that 57.70 level. And, it's worked out price wise. And if they want to grind around sideways every day that they go back and forth, obviously I'd prefer not to see any days going against my position. But just remember, this is how decay works. When you have a close up one day, a close down the next day, the more back and forth you have, the more the decay on those leveraged ETFs, and that's why I shorted LABD instead of shorted LABU, the bullish biotech ETF, instead of going long LABD, the bearish biotech ETF. So that's that. And I do want to point out another potentially bullish development is we broke through. We had this trend line off the lows. This was sort of that oversized, large weekly bear flag pattern on the weekly chart, and we broke below it and even closed below it last week, but we've snapped back up above it. So a little bit of a mixed picture right now. I'd like to to keep the bearish case alive, I'd like to see today's gains get faded quickly, like in the next day or two. And it would be great to see it faded by the close. It's 12:40 now Eastern time, so I'll wrap this up. Couple hours ago. I'll try to get this out there. That's what I'm seeing right now. So what I did today is just basically focused on the Qs, made a case that as far as, despite today's strong day in the Qs, biotechs are up nice. They're really giving a boost. The Qs have a lot of, right behind technology, you have a big weighting in biotechs in the Qs. And so that was my point, that we haven't really, for the bearish case, we haven't had any technical damage inflicted yet, although there is certainly the potential if the market continues to build on these gains today and especially throughout the week. But as of now, I view this as nothing but just a one day up, especially with prices heading into resistance with key EMAs and key horizontal levels. And it may prove to be a good shorting op in hindsight, or at least an area to add on for those interested. Okay, this has been Randy Finney with the right side of the chart. Hope you enjoyed it.